Well, it's going to be just about 10 o'clock on the dot after I do a few of the intros. But if you guys have joined us in the past for one of our Ebury webinars, welcome back. As you know, we try and keep things short and sweet. We can't try and keep things to the point. James has had over, I don't know, what, 10, 12 years experience in FX markets now, James. I've had close to 8, 9. So we've been doing this for a long time. And what we're doing today, what we're presenting to you guys is, I guess, a summary of what's happened in 2021 and what we think will happen in 2022. What do you think, James? It's going to be an exciting year, a volatile year, or a scary year?
No, hopefully not scary, but in terms of volatility, yeah, certainly getting back to those levels that we've not really seen sustainably for about 5 or 6 years, I think.
No,
how about yourself?
No, I don't know. I'd like to go with the theme that this is the year we get out of the pandemic. But you know, we're kind of learning the Greek alphabet with each variant that comes out, so we'll see how we go. So let's kick things off. Let's do this. So to give you guys a view of what we're talking about, we'll do a quick intro. James and myself will go through what will drive markets this year and what drove markets last year as well. And then James will go on and talk about, you know, some interesting things about inflation, what that means, what it means for central banks, and what it means for the currency. And we'll talk about interesting trends that we're seeing with our importers in particular. We've spoken about this before. We've done a webinar about this before. And we just want to talk about it again because it's quite relevant. It probably helps describe the inflation story as well, James. So then if you agree with me, but the Aussie CNH stuff is quite interesting. And we will just run through what we could do for you guys at the end, you know, for some of the new products that we're releasing, what we are excited for 2022. So just a quick one from us. My name is Pat. I'm one of the senior dealers at Ebury. I was here from day one. Really exciting 4 years at Ebury. And yeah, really happy to present to you guys. James, did you want to say a few words?
Yeah, that's me on the right in that ill-fitting jacket, and that's our favourite pub in the background. But yeah, just a brief background about myself. Recently joined Ebury, but been dealing in the FX markets for about 12 years. And before that, had 5 years as a stockbroker. So I think I've seen 1 or 2 cycles in the economy, and I'll tell you what, they're never the same.
Cool. So like what we were saying, we think, you know, conventional moves in FX markets are what we're going to see this year. The last 2 years, we've really talked about, you know, the pandemic, COVID, Omicron, and basically trying to stay head above water. As a common trend last year, the AUD and the NZD, the antipodean currencies, they very well underperformed. A lot of that's to do with, I guess, inflation pressures, and as well a lack of vaccine supply. If you guys recall last year, the narrative for the second half of the year was we need vaccines, we need jabs and arms, we need to increase that number, because compared to the rest of the world, we've been closed in terms of international borders, and everyone's been, you know, growing back into some type of normality. What we should see this year, though, is a complete unwinding of that. Instead of keeping head above water, we need to control all this, all the growth that we're seeing from free money. Low interest rates means it's easier for everyone to grow, expand, and, you know, find better opportunities, right? That's what money gets. But with that, we might grow too fast and inflation becomes an issue. Now that's James's expertise. He'll talk about that later in the webinar. But what I'll talk about to start off with is just an intro and some COVID news and how that could impact us this year. So to start off with, as a quick intro, key drivers for 2022. We've highlighted them in 3 points, James. Infections, inflation, and interest rate, the 3 I's for this year. What do you think? What would be the biggest driver out of the 3?
I think now we're finally moving away from infections and back over to inflation and interest rates and economic fundamentals. Last year, I think in the first 4 months, it was all about who suddenly saw spikes in infections. And if there was one, then you'd see the currency of that jurisdiction fall away. Then as the vaccine drives got going, it was all around who was vaccinating quickest. So that's why we saw a lot of pound strength in the middle of the year. But I think finally we've just drifted in the last 3 or 4 months to getting back to normal economic fundamentals, and infections, unless there's something really major, which would probably affect all of us globally, should probably have less of an impact. But yeah, number 2 and 3, I see as absolutely vital this year.
No, I completely agree. I feel like everyone's just a bit over the view that, okay, I've got COVID, I need to stay at home. I think everyone's learning to live with it now. I think that's a new trend, right?
That's definitely.
So as a summary, we're looking at what's happening in Australia. ICU is probably what we're looking at. ICU residents, how many people have been really hit hard by the virus. And that's been relatively low in Australia compared to the rest of the world. Yes, our cases are picking up. I think it was a bit of a shock in the system in January, but now it's a bit normalized. The lack of PCR testing as well has probably contributed to that, and more rat testing as well. But from the stories that we're hearing on ground, the main impact of the infections is, the workforce. When someone gets COVID, they can't work for 7 days. What does that mean for a business? It really puts its strain in terms of planning this year. So that's probably one of the key points. The big thing that we're going to probably see over the next quarter is an increase of the booster shots, maybe mandatory booster shots as well. And that will give us clear mobility on what's going to happen. People and businesses can plan a bit more, and we could probably get on a better track this year to, go back to some type of normality. And as we said previously, Omicron isn't that bad compared to, say, the Delta virus or the original strain. I think it was called the Alpha. And most economies, most businesses are getting into the view that this is something that we can live with. This is going to be a virus that we can, move on and say we could plan around this, A teams, B teams, and build to normality. So what does that mean? In the past, if you guys recall what happened in March 2020 and what happened in July 2021, we know that once we had a spike of cases, typically the next move is a government would go into lockdown. So, risk pressures go up. Since the Australian dollar really trades against the emerging market currencies, the risk-based currencies, we typically see that currency fall. A really big driver of the move in March 2020 and July 2021. However, now we're seeing that we're not as sensitive to COVID fears, which we've been talking about. And the Aussie isn't suffering too much against that. Right now, James, correct me if I'm wrong, I feel like the downward movements in the currency are really coming from central bank movements or decisions or comments rather than, say, a new variant or a rise of cases.
Yeah, most definitely. So to that end, with pound, Norwegian kroner, and Canadian dollar being the 3 outliers, what would you say is of those 3 currencies got in common there?
Which ones? Pounds, NOK, and CAD. I feel like they've been raising rates sooner than everyone else.
Yeah, most definitely, most hawkish in their sentiments compared with say Japan, who are probably going to be on hold for indefinitely.
I mean, they haven't really talked about raising rates in a long time, Japanese. Yeah. Cool. So do we consider new variants? I think there's a new Omicron variant coming out, which is 15-20% more infectious. But I know my view, I think we're over this COVID phase. And markets, like we said, what do you think, James? Do you think we should worry about what other alphabet letters are we missing? A beta variant, a pi variant, an infinite variant, right? I think
Yeah,
we're over this.
being sensitive to the health side of things, may not necessarily yet be endemic in a health position, but in terms of the markets, it most definitely is. The market really calmed down quickly after Omicron initially came out. There was an initial shock, and then the markets got used to it, priced in the risk very, very quickly, which is kind of similar to where we were 20 years ago when terrorism was a big concern after 9/11. That as we then subsequently saw attacks, as dreadful as they were, we just weren't really seeing the big impact on the markets because the markets have got more efficient at baking in the impacts of what's going on. So I think this is what we're now going to see here.
Cool. So generally, to summarize the COVID impact, what we will see this year will most likely be positive for the dollar. We most likely will see vaccine rollouts catch up. We'll see, developing nations open up again. We might be able to travel to Bali, the Philippines, Southeast Asia will be open up again. We're also seeing a trend of higher commodity prices. I think that's driven by Chinese demand as well. James will talk about that later. But generally, my view, I've always been an Australian bull, an AUD bull. I always like to think that since we are commodity related, iron ore related, and really can stand in our own 2 feet, despite what's happening overseas. James might correct me later. I still see positivity in Aussie, and I really hope we don't see, against the USD at least, a 6 handle in front. You don't really want to be trading with a 6.9 or 6.8 handle. I reckon low of 70s, maybe up to 75 by the end of the year. But that's enough of my talk about how Corona and COVID can impact the currency. James will talk a bit more about inflation and central banking from here.
Yeah, thanks, Pat. So inflation is most definitely no longer transitory. America is most definitely leading the way. 7% increase in consumer prices over the last 12 months, which we've not seen since 1982. Australia's isn't quite as severe. We're most definitely at multi-year highs, but well behind America. But 3.5%. It's the first time we've actually had inflation this high since the GFC. The RBA believe that it will be transitory for a few quarters, but that remains to be seen. So I think that's the big debate, really. On that from the RBA, Pat, do you believe what they're saying, or do you think that inflation's actually hanging around?
I was talking about this yesterday in my interview. I just feel like, are they too patient? Is Philip Lowe being too patient about interest rates? Or is he trying to buy time? Just because I guess the worst thing they can do is move higher too fast, don't you think?
Yeah, I mean, I guess one of the big problems was that they were raising interest rates in America from 2015, 16, 17, when inflation was just incredibly low, and they were forecasting that it was going to pick up, and they wanted to get ahead of it. And they were raising rates to counter inflation that never happened. So I guess
an interesting thing about Aussie as well is, well, the US report inflation on a monthly basis. I still don't know why we do it, but we report inflation on a quarterly basis.
Yeah, probably yet to feel those effects. So I mean, the inflation number that we saw just 2 weeks ago is dealing with a passage of time from the beginning of October.
It's kind of irrelevant now.
Yeah, particularly considering we were all stuck at home at that point. Seems so long ago.
Exactly. Go to the next slide.
As well as inflation diverging, we're also seeing economies growing at different rates. Australia, we've seen a bit of a bump because we're recovering from the Delta recession that we had as a result of so many jurisdictions being locked down. The American economy, though, is definitely outpacing global growth. Activity there has been put way ahead of health, and the cries to get back to normal that you're seeing, what they call restricted at the moment is way above what we're hoping to get to here. But China's growth is most definitely being held back just due to the fact that they are still pursuing that zero COVID policy. And as a result, that's massively dragging on travel, particularly international. And services going out to restaurants, etc., is way down. The IMF, interestingly, they expect the global economy to grow only 4.4% this year, which is down from a 4.9% prediction 3 months ago. But the IMF have got a typically do get this quite badly wrong. They were all in the economic growth period from 16 to 20, they were probably far too optimistic. Whereas now it seems since the pandemic's hit, they've been way too pessimistic. But the markets do quite hold on to what the IMF says. You know, they're seen as quite valued predictors. So again, there's just going to be a bit of fluctuation in the markets as the predictions and the reality come aside.
Why do you think the IMF get it wrong all the time?
I guess they're getting it wrong for the same reason that so many are. They're just looking at what's been happening rather than what might change. I think even the IMF, the institution that they are far too reactive to what's going on, and they work their predictions on the basis of continuation of what's happening now, as opposed to setting out scenarios for what may occur in the future and how that will influence what the market's going to do.
I feel like we'll see that the markets are always right. Don't you agree, James? They've been pricing in rate hikes from last year, but central banks and these big institutions just seem to be playing catch up and, like you said, being reactive.
Yeah, but stock markets might not always get it right, but the bond markets do, and the bond markets are predicting something a bit different. Just a few statements for you here from various central banks and authorities around the world. My view, if you're having a look at a bit of a Goldilocks scenario, is that the Federal Reserve are perhaps looking too hot with regards to inflation and interest rate hikes. They really see inflation as a huge problem, and they're going to tackle it aggressively. On the flip side, you've actually got China at the moment, which is a bit more run by the government, their central bank. It's less independent than what you see here or in the States. But at the moment, President Xi has warned the world central banks and world leaders that there'll be a massive challenge to global growth if we see monetary policy tighten. Perhaps too cold, though, I think, to be loosening monetary policy at this stage. Is probably not the way to go either. And to be fair to RBA Governor Lowe, he's been fairly measured. He's given himself some optionality. This recent statement saying that they won't increase the cash rate until inflation's sustainably within the 2 to 3% target range, and they want the labour market to be producing wages growth that's going to help consumers stay in touch with the actual price rises that they're seeing. So perhaps we're on balance over here in Australia.
So we've got just right.
Just right.
Nice one.
This is just a quick interest rate expectations here for the RBA and the Fed. This is according to overnight index swaps as to where the market's going to be, as opposed to any kind of economist prediction. The RBA basically just going to be tracking Big Brother throughout the year, just maybe staying a couple of months behind. The Fed had almost nailed on to raise rates in March, some calling for a second rate hike. This week, everybody had been quite in the camp that there was going to be a June rate hike, but it's looking a little bit more murky as to whether that'll be June, July or August. But once they lift off, it's expected that we get to see 2 or 3 more hikes fairly quickly.
Now, for the people in the webinar today, James, what does that mean for us? Just because, let's say, we know that the Fed's going to raise rates in March. Will that mean in March the currency will drop? Will the USD appreciate? I guess how much value do we see in the market based on what's priced in? I mean, the expectation is a rate hike, but it doesn't mean that the currency is going to appreciate because of that, correct?
Yeah, most certainly. I think it's really important that the market doesn't respond to what is going to happen. It responds to changes. So at the moment, the Fed are nailed on to make that interest rate hike. And if we look back to the beginning of their last rate hiking cycle, December 2015, they announced that rates were going to rise, and we barely even saw the US dollar move a pip or two. It was completely priced in.
Exactly right. So something to note for the guys listening today, just because they are raising rates doesn't mean the dollar will go up. We already know it's going to happen. If we know it's going to happen, it's not going to really impact the exchange rates.
So just summarizing a little from the previous chart, that the RBA will probably sit a quarter behind. It's interesting, actually, this is going to be the first RBA rate hike since November 2010. So I think that's probably quite important for a few business owners, investors, perhaps even market participants who would have been a lot younger, may not have even seen an interest rate hike at any point in their career. So how that'll affect the markets.
I've never seen one in my career. I tell you that.
showing your young age there. But basically, both to have caught up, and America to just be remaining ahead. The European Central Bank was penciled in for a solitary hike. That was actually until just a couple of hours ago. Overnight, the ECB actually announced that they would be looking to change things from March. They're still sitting a bit on the fence, but as a result of that, you've got the market penciling in maybe a hike or two for this year. New Zealand have already raised rates twice. The UK have put in another rate hike today, so they've gone twice. And actually, it was a vote of 5-4 against hiking with a 0.5% rate increase rather than 0.25. So it seems like they really want to jolt the market over there, suggests that there's more concerns ahead. Whereas China, their interest rates are much higher than the G10 at around 3.5%, but they have signaled that they'll be reducing rates throughout this year, which would probably be fairly positive for.
That'll be good for us, won't it? I think you talk about it later on.
Yeah, we'll go a little more into that. So I'll just give you a brief summary of the Reserve Bank, the meeting from Tuesday, and what they saw. First off, they basically said that they were going to stop this quantitative easing program. There'll be no further purchases from next week, and that they'll then start to run off the bonds that they're already holding as they come to maturity. They won't be reinvesting the proceeds, so that they call that running off the balance sheet. And the RBA will be holding a lot less of current government bonds than what they have been, and that then will basically reduce the money supply, which in turn may just put a lid on inflation if there's less money chasing the goods that are currently out there.
There's not as much free cash in the market, won't you say?
Yeah, there's most definitely a little bit more thought around how money's going to be spent and invested, as opposed to just a bottomless pit of cash that's been coming to the market.
Bottomless pit of cash, indeed.
They basically spoke about the Omicron outbreak in exactly the same way as they did Delta 2 months ago, which is that they believe it won't derail the economic recovery permanently. They've slightly upgraded inflation from 2.5% to 2.75% for next year, but they think that we'll only have this 3% plus inflation for the coming quarters, whether that's 2, 3, or 4. I guess they've been deliberately ambiguous. They've also flagged the wages growth is still expected to be only gradual. But they also did acknowledge that there's been some quite significant progress towards the RBA's goals, such as the unemployment rate falling. It's currently at the lowest level since the GFC. We've got there a lot quicker than they thought. And they spoke about how really inflation is a supply side problem as opposed to demand. Hence, I guess that supports their view around inflation being transitory once supply bottlenecks get released.
Build more ships. Is that the solution?
Apparently, more ships,
build more containers.
Probably need a few more drivers to drive the containers from the port. I think it'd be a big problem for some of our clients. And they basically just hedged their bets. The board is prepared to be patient. What do you think that means?
I mean, they're buying themselves time, in my view. They want to see how this pans out. Once, we go a few months underneath 2022, we might be able to make a decision, or they might be able to make a decision. But on that note, James, how do we plan for this? I mean, we describe central banks as either bulls, bears, or wait and see. I guess the three different scenarios, talk us through how our clients can plan for each one and what it means for the dollar.
Yeah, so I think it's more around the uncertainty. Now, like with America, everybody's penciled in this March rate hike for months now, whereas the RBA, nobody quite knows. It's expected that we will have a rate hike by August, but we don't know whether it's going to be June or July or August itself. So that's, I guess, a bit of an issue in terms of forward planning, because the market at the moment sort of doesn't believe the central bank here. So they're not going to catch up with the central bank's forecasts until the central bank actually does something. What's remained consistent, though, in our views of the pricing of those interest rate hikes is, regardless of when they're going to happen, there's still 4 priced in the next 12 months. To give you a bit of background, though, Governor Lowe, he took over nearly 6 years ago as governor of the RBA. In 2017, conditions were there all year for policy tightening, but he resisted doing it. Namely because the currency was fairly high. Aussie US reached 80 cents for the first time in a couple of years on the back of the expectation of policy tightening. He felt that would be detrimental to the economy if we raised rates and the Aussie went even higher. So he held back from actually raising interest rates. And then we saw it come lower. February 2019, again, Aussie was fairly high on the basis that we were possibly going to be raising rates later that year. Suddenly there was the backflip from when he said that we were more likely to be lowering rates as our next move than raising. And then we saw some fairly substantial rate decreases in the winter and autumn, spring of that year. Of course, he responded well in 2020 to the pandemic by actually cutting rates right off, and then a slight cut again in the following November. So I guess we've got 2 scenarios here. We continue with this measured policy. He's going to stick with the wages growth as his reason for keeping interest rates down. Wages growth has been really stuck below trend for about 10 years now. So if we see that and they don't raise interest rates and we're still sitting here at 0.1% at the end of this year, we will be then well behind the other central banks, and you'd expect the Aussie to be down in the low 70s to high 60s. I guess the bullish case is that he actually takes action. We see interest rates rise, the economy doesn't fall off a cliff, and then suddenly they have the confidence to raise rates even further. At that point, I think you'd really see the market catch up, and we'd then see the Aussie sort of in that 75-cent range, which has been about par for the course since we floated the currency 40 years ago.
If you had to go red or black, James, do you think we're going to be a bear or a bull this year at the RBA? You know me, I'm a bull. I think we're going to be, smooth sailing. We're going to see, those milestones hit, and we're going to see hikes soon. But what's your view?
No, I do think that they're going to be in a position where they have to raise. It'll almost be detrimental to the economy for holding on. So they'll just have to follow. So I agree with you. It's going to be bullish, but reluctant bullish. And that might be just what keeps the lid on it a bit.
Just shaky hands on the rate hike button.
Yeah.
Great. Now let's look at the USA.
Okay, so the US Federal Reserve, they actually met on Australia Day, most definitely more hawkish on interest rates, which the market expected anyway. Inflation well above the 2% target, of being at 7%. Their labour market is very strong. Huge unemployment report tonight, actually, where if we see that increase in wages growth, that's where the committee is really saying that we're on target to do something. As a result, the market is 115% priced in a rate hike for March. 115% means is that there's actually a 15% chance of a 0.5% increase as opposed to just 0.25%. And they've clearly said that they're going to adjust their stance as appropriate if risks emerge that could impede the attainment of the committee's goals. So a little sitting on the fence, but definitely more of a hawkish vibe. And the fact that they're really talking about supply and demand imbalances and the opening of the economy, as opposed to Governor Lowe, they haven't put in that caveat where they expect it to come off. They believe that it will be a problem unless they act. So the path of the economy from their point of view continues to depend on the course of the virus. I think that's an interesting one because so many in America actually believe that the virus is just going to go away. So the more hawkish position there.
Well, they've got no travel restrictions really at the moment. I mean, Aussies can go into the US pretty easily now from what I'm hearing. So they don't really care about the virus. My fear with the Fed is I feel like they could overcook this. They could raise too fast. And going back to what you said about the Goldilocks comparison, I think they might get it too hot. What do you think?
No, I agree. I think as well, just with the Democrats that normally supported higher interest rates, as opposed to the Republicans who like to keep interest rates low. So I definitely agree. I think they could go too hot if they go too far with it.
Midterms this year as well. Do you think that's got anything to do with any impact on the market or what the Fed would do?
I think the midterms will probably just keep them from withholding any fiscal stimulus. There's nothing like splashing the cash around in some of those marginal.
Or just dangling the carrot right before the votes need to be cast.
Yeah, so they won't be using tax increases to slow the economy down. The Fed is going to have to do the lifting for the government. Hence another reason we could go too hot.
Yeah, okay, no, that's fair enough. I guess same thing with what we did with the RBA. Let's do the same thing with the Fed. We've talked about, a few scenarios. I'm saying they could overcook this, but talk us through what does it mean for our clients, for the guys listening today, if the Fed do overcook it or undercook it in terms of raising rates. We know they're going to raise it, but the question is how many and what the impact will be from there.
Yeah, so I think at the moment, as we said, we've got that rate hike priced in for March. It's not going to be a shallow path. We could really see the Fed move very, very quickly. So four becomes the norm, and the market's perhaps expecting that to continue into 2023. Jerome Powell, to be fair to him, he's had a lot of political pressure on him from Donald Trump. After he was
Trump's still in the conversation.
Now, earlier on, he was Trump's man. Trump was very keen to get rid of Janet Yellen and put Jerome Powell in his place, which that you wouldn't see that in this country where the government would be meddling on who's in charge of the RBA. Powell actually raised interest rates through the first half of Trump's term. Trump was tweeting all kinds of abuse every time they did anything on Twitter, and then Powell really just eventually bowed to the political pressure. He realized that he was going to be pushed out unless he did something
out of a gig.
Yeah, so he would have lost his job if he wouldn't have cut those rates 3 times in 2019. So I think that it gave them less ammo for when the start of the pandemic happened. They had less ammo to actually slash rates as much as what they would have wanted. Rates should have been at 2.5% instead of 1 3/4. They didn't quite have the effect. But yeah, the pathway of the Fed's interest rate journey is well priced in, far greater certainty than the RBA. I guess it's just any kind of economic, political, or health conditions could change substantially to make them depart from the policy. So, right now it all looks very rational, very straightforward. But if there is a headwind, if there is something that pops up, a black swan event, that's where there'd be a lot of risk to the US dollar. Whereas with the RBA, if there's a big black swan event, it's not going to derail something that's so certain because we don't know what's happening anyway. So I guess in that way, there's more risk to the USD. But I think most important is to actually have a look at what's happened in history. The last 5 big tightening cycles, going back to the mid-1980s, the first 100 days after the first rate hike, the US dollar has weakened each and every time. Gold's risen and equity markets have also gone up. It's almost kind of like once the Fed acts, the market then trends the other way. So the old saying of buy the rumor, sell the fact. And in fact, last time the trend was already underway before the Fed made its first hike. It had already started to slightly weaken. So on that basis, you'd expect the US dollar to peak around early March or mid-March, and then for the USD to fall away. So
more downside risk for the dollar, sounds like.
Yeah, downside risk for US. And Aussie US, I think last time had a pretty, despite Aussie US initially falling in the first month after that rate hike in early 2016, the rest of the year was very strong for Aussie US. We went up from 68 to 78 very quickly.
I think the importers and Nicole here would be really happy to hear that, and be even happier to see it eventuate. We'll go on to the PBOC, a central bank that we don't normally talk about, but we're going towards the end of the webinar, guys. So if you do have any questions that you want us to answer, feel free to start jotting them down on the Zoom question box. So James and I can have time to answer them towards the end. So PBOC, over to you, Jimmy.
Yeah, so the PBOC, it's not quite the same level of scrutiny as what we see. I mean, over here and in the US, we know all of the board members by name because one's bullish or one's bearish. You don't see that from the PBOC. It's very simply, you're really based on action. They don't have continued press conferences and constant coverage and media scrutiny. So we look at their actions, which is that they actually cut their rate by 0.1% recently. And in December, that was on the back of a December move, which was the first one since the very beginning of the pandemic. Short-term rates are also being cut. And you've got a lot of pressure from the top of the tree in China, President Xi warning the world against rapid tightening just a couple of weeks ago. So it's most definitely contrary compared with the rest of the world. In terms of Aussie positive versus Aussie negative, my belief is that should the PBOC actually continue to loosen monetary policy, it'll stimulate investment, particularly in real estate, which is great for us because it boosts demand for commodities, part of building those structures. And encouraging growth in China will also be very good for global growth due to the fact that it'll increase demand for manufactured goods. But on the other side, what the PBOC loosening will do is devalue the Chinese yuan, which will mean the US dollar is kind of the default currency for those funds to go into. And that could place downward pressure on Aussie US. Also, make the US dollar more expensive at a time when American interest rate repayments are going to be rising because their interest rates are going up. So that the impact there on global growth and investment could be a negative one. So I guess we'll see how those scenarios play out. Anything to add at all, Pat?
No, I think what's happening there, I'm a bit different from a lot of the views that we're seeing with the PBOC. I don't think that, rate cutting over there is the worst thing. I think that's going to help us purely from a commodity demand standpoint and the trading relationship we have with China. So I like what we're seeing from China. It adds to my narrative of being an Aussie bull, right?
Yeah, that's a good point.
So what does it mean for the currencies? Talk us through that, James.
Yeah, so what we've got here is just a table of particularly the ranges that the Aussie has traded against the CNY in the last.
Is that right? 30% in 2020.
Yeah, I guess that was more just down to the Aussie dollar really being the most negatively affected currency when the pandemic actually hit. But what I see really is that harmony that we had from 2017 to 2019, that's kind of gone away. Australia is not just tracking China's manufacturing sector anymore. Although RBA rate cuts in 2019 coincided with a slowdown in China's wholesale price growth, What we have seen though is bigger divisions between Australia and China. The iron exports might remain strong, but there's a lot of tariffs now on other goods and services. You've also got divergence between the two central banks, whereas the RBA would follow that Chinese manufacturing sector activity. We're looking like we're going to raise rates, whereas they're going to cut rates later this year. So these larger fluctuations are most definitely here to stay. I think that's really going to make things a little bit more difficult with Australian businesses dealing with China, who have Aussie US conversions and then US dollar to Chinese currency conversions to deal with, where all three central banks are moving differently. So I think that most definitely managing risk when doing business with China is going to be a lot more important exercise now than say what it was over the last few years.
And just to make sure we don't miss it, I think today's officially Chinese New Year as well.
Yes, I think it's the final work day of the holiday. It's interesting though, as Pat was saying earlier, nobody's doing anything. The trips that people are making to reunite with their families back in the countryside are significantly lower than 3 years ago because of the zero COVID policy. And that's really just disrupting everything. I guess the people who do go back might decide that they're not going to go back to their factory jobs after the holiday. So we could see even further disruption to manufacturing and to shipping.
No, I agree. And to our Chinese attendees today, Kong Hee Fat Chai. Forgive me if I pronounced it correctly, if incorrectly. But yeah, have a prosperous year. And just to cap off, the main things we could help you guys out with at the moment, seeing why James and I have really good conversations about this with our importers, the discounts and the relationships that you improve by paying in CNY is very important. Feel free to ask any of the guys, any of your relationship managers about more detail about it if you haven't in the past. We will be bringing out more hedging products this year, so that's going to be really exciting. If you haven't discussed a policy, taking into account everything that's happened over the last 12 months and what could happen over the next 12 months, it's probably the time to talk about it with your relationship manager. I think a few of you guys in the call have James and myself, so we're more than happy to talk to you guys after this call. Trade finance is always something that we've offered, and it's only going to improve. I know risk appetite is improving internally, so if you guys are looking for more cash with tightening policy across the globe, so we're always happy to have those conversations. And we've actually grown our e-commerce and collection platforms. We could collect more currencies if you guys are looking for more markets to go into, and we're actually making payments faster. We've improved some internal processes, so instead of waiting a couple hours, you just have to wait a couple minutes for some payments now, which is awesome. So now we go to questions. James, I think one question we got asked was iron ore prices. I know we didn't really talk about it in this webinar, but iron ore is around 140 a ton at the moment. It dipped a bit towards the end of last year. A lot of it's to do with the Winter Olympics and a decrease in production in China. What do we think will happen with iron ore this year and that impact on the dollar?
I think we've got to look at the demand and the supply side. From a demand point of view, I think we will continue to see pretty heavy demand here. China is continuing to invest in infrastructure, and there's very high demand for manufactured goods. So that side is going to be pretty solid. I think the issue though is supply. The Australian exporters really benefited from that all-time high in iron ore prices last year due to the fact that we had so much offline in the rest of the world. Chile and Brazil really were struggling, whereas now a lot of those mines are coming back online. Some of the shipping delays have been fixed up. So I think there's a little bit more competition in terms of where the supply is coming from for pretty much around the same level of demand. So might not see those prices go back to those records that we saw last year, but then also Australia's share of those shipments will be a little bit lower as well. So hence our export values and tax take is going to be a bit lower.
Great. Okay. I'm going to try and keep this at 10:45, but we'll try and squeeze 2 questions. One question that we had was, we both agree we're both Aussie bulls at the moment. Should we be concerned about, global political issues like what's happening with Russia and Ukraine, China and Taiwan? Is that something that could materially impact the Aussie? Do we trust Putin? Do we trust? I think Boris Johnson and Putin are meeting at the moment. They might be partying. I mean, BJ's been notorious for doing that. But what do you think could happen with Russia and Ukraine and the impact on the currency?
What we've seen with geopolitics the last few years is that when something like this suddenly emerges, such as the issues with Iran at the beginning of early 2020, with this as well, you tend to see a brief shock in the markets, but then as the situation doesn't escalate severely, you then see some normalization. Whereas I think the last time that the world went to war, the war in Iraq, it was only really on the eve of the war in Iraq that we suddenly saw mass panic in the markets and big lows for stocks and high volatility. Albeit actually on the first day of the war, you then saw things settle down again. So I think things would have to go a lot further for those geopolitics to really have that major effect.
That's the great thing about hedging, right? If you've got a hedge in place, you don't have to worry about those little spikes in market or dips in market.
Yeah, most definitely.
Great. Well, that's 10:45, guys. I'd like to thank everyone again for attending. If you guys have any further questions or would like to know more, reach out to your relationship manager. These are our details up there. James and I are always open for conversations as well, so you guys just don't have to talk to us through a webinar forum. We're always happy to take a call or a video chat. And yes, have a good rest of your Friday. Hopefully it's early, and have a good weekend.